G'day, Greg.
Woody, how are you, mates?
Good, mate. You must be really pleased after last night's game.
Very happy, man. Very happy. I've got to talk to Vern yet, but yeah, very happy.
Yeah, well, it was a hot historical result. Just like the markets are pretty historical, they've been hitting all-time highs all over the shop. So I thought it'd be good to just have a little catch up because you wrote this thesis, which was called very handily "Life at Zero," and that was pretty much first published that you started talking about it late last year, but we published a big report on it at the start of this year. So I wanted to maybe come back to that and see where we are in Life at Zero. But before we begin, do you think you could just very quickly sum up what you mean by Life at Zero? Just because there may be some new members on the Insider which don't necessarily know what that idea means.
Yeah, sure, mate. So Life at Zero is really about trying to create a story around how the markets are going to behave in an environment where central banks will keep interest rates low for a long, long time. And we've heard the RBA come out on a number of occasions and state that they don't expect the official interest rate to start moving up until 2024 at the earliest. So what I wanted to do was try to tell people that, because around that time we're talking about at the end of last year when the Aussie market had staged a big bounce back from its historic sell-off based on the pandemic and the lockdowns and stuff like that. And I think around that time, a lot of people were still expecting markets to roll over and crash to new lows. And my view was that we would more than likely go to new highs. And I was certainly accepting of the view that the economy wasn't particularly healthy. And that there were genuine concerns around why markets would turn back down and the economy would struggle and stuff like that. But the Life at Zero thesis is around the idea that the real collapse comes in the value of the currency. And when you try to devalue currencies by holding interest rates really low for a long time, when you create huge amounts of fiscal stimulus, the currency is the main casualty of that. And what that actually means is that people who are sitting with cash in their accounts just think, I can't keep doing this. I'm earning no money on my cash. I'm going to go and buy a property. I'm going to put my money into the share market. I'm going to buy these big stocks. So my view was that share markets would go higher and the Aussie market would make a new all-time high. But what I also said is that you can't just blindly go into the market and buy anything. I mean, sometimes that works out, but you do need a strategy. And the strategy that I proposed was that, I would focus on large cap stocks, so predominantly stocks in the ASX 200. I would focus predominantly on stocks that were trending higher or starting to trend higher. So at least we were investing with the momentum and not against it. And thirdly, looking at stocks that had decent value characteristics, and whether that value was in terms of plain old intrinsic value being below the price, or whether it was more along the lines of a sector that was terribly out of favor and had been underperforming for some time, but there were indications that turnaround was coming in. And we can talk a little bit about specific investments later, but that was the idea behind it. And as we've seen just in the last couple of weeks, the ASX 200 has gone on to new all-time highs, and that's largely because of the banks and the big iron ore miners that have been making a huge amount of money from China's appetite for iron ore. And that's just pushed our market higher. So, here we are at all-time highs. And I think the feeling of people that were expecting the crash, that sort of bearishness has gone out of the market now. And we're now at a point where it seems to be most people are bullish. And to me, that's a little bit concerning. So, I guess that's one reason why we're chatting today as well. The sort of Life at Zero idea isn't about stocks just going up year after year after year. It's over time. I fully believe that the stock market will be much higher in a few years' time, given this currency depreciation. But there are also going to be periods where you're going to have to endure some pretty nasty corrections. And I think we probably aren't too far away from one of those periods at the moment.
I was going to say, so now that we've hit all-time highs in various markets, where do you see them going from here? Like, for example, so you said it's the currency devaluing, not necessarily the values of the assets at play. What next? What are you expecting over the next couple of months? Say, is it going to be pretty bumpy? Incidentally, by the way, sorry to interrupt before you go in. We just had a new signal from one of our analysts' algorithms, which judges stress in the market, and that's just triggered an all cash signal, which is quite interesting as well.
Yeah, absolutely. And you know, it's been doing that on and off for a little while now. And I think that just gives you an indication that there is a lot of concern that the market is reasonably pricing in most of the good scenarios or good situations that most people are sort of looking at. So yeah, in answer to your question, I think we're at the point where a lot of the good news has been priced in. I mean, if you think about the amount of stimulus that's gone through the Aussie economy and the global economy over the past 12 to 14 months or whatever it is since the slowdown last year, that has getting to the point where it's increasingly washed through the system, and the market will then be turning around and saying, well, okay, where's the next hit coming from? Because when you back out all that stimulus, the underlying economy is still not particularly strong. Like if you look at overall lending data or credit growth in Australia, it's not particularly strong, which suggests there's not a huge, private demand for borrowing. Most of the borrowing is coming from the government through its fiscal stimulus. The same thing in the US. Nearly all the credit growth over there is due to government borrowing, not to do with private sector borrowing. So, and now you're seeing bond yields that have peaked. So just to give people an idea of what bond yields represent, when bond yields are rising, it tends to reflect a strengthening economy, concerns about inflation and overheating and all that sort of stuff. And that narrative has been in the market for a good number of months now. And, everyone's been talking about inflation, when's the inflation coming? And I've been writing in the Insider that, I think the inflation is transitory, which means that, we're looking at comparisons with a year ago when the economy was in shutdown and almost deflationary. So of course, those short-term signs of inflation are going to look really bad, but they will wash out as the comparisons change. So I don't think we're in an overly inflationary period. And if you look at bond yields, in Australia, they peaked in late February, and in the US, they peaked in March, and then they've now started to come back down, which means the bond market is looking at the economy 3 to 6 months down the track and is starting to price in a bit of a slowdown, which I don't think the equity market has actually priced that in. So I don't think you're going to see, I think you're going to make a distinction between a correction and a crash. And I don't think we get into a situation that we saw last year. I mean, that was a historic crash of 35, 40% in the Aussie market in a matter of a month. That was extreme. Since then, the biggest drawdown we've seen in the market in the ASX 200 is a 7% correction that we saw in August and September last year. Hasn't been a bigger one than that since. So my view is that we do get that in the next few months, and we might get something in the realm of even 10 to 20%, and that might be a short-lived bear market. But one thing I'm pretty sure of is that once you get a slowdown, once you get the equity market reacting to slowing economic growth, and maybe companies warning on earnings expectations and things like that, you're going to get governments and central banks doing exactly the same thing: more stimulus, more talk about interest rates, holding interest rates lower, putting more money into the system, and then that will send the currency, obviously debase the currency and send more cash and assets into the equity market. So I think people are just got to be prepared for a pullback, but certainly it's not something longer term that you can sit in cash and wait this out, because the only playbook they have is more stimulus.
Yep. Well, one of the things that the RBA have just come out with, they pretty much promised that they're going to hold rates to near zero till at least 2023 or 2024.
Yeah, I think 24. Yeah.
Do you think that's linked to the decrease in bond yields?
Well, I think partly it is just a recognition of the fact that the inflation story is transitory, and they think that it's going to take a long time for the economy to get to a point of unemployment at certain levels that then create the price pressures that will necessitate an increase in interest rates. And I think what central banks have done in the past have probably moved a little too quickly to tighten when they've seen signs of economies growing, and all it has been over the past 10 years. And this is part of the idea behind Life at Zero is that we're getting in further and further debt. With every round of stimulus, it just creates more debt, and that makes it harder for the global economy to grow out of that debt hole. So anytime there's a stimulus, everyone thinks, oh, okay, we're growing. It's time, we're getting back to normal. That's not going to happen. There's too much debt in the system for you to get sustainable growth now. So the idea that we're getting out of this, and then central banks say, oh, we're growing, we need to increase interest rates to contain inflation, and then that leads to another slowdown. So I think they're sort of conscious of probably putting the brakes on too early, which is why it's very much a psychological game where they're trying to tell borrowers, look, you can borrow for years and we're not going to put interest rates up, so go ahead and borrow. I think that's all it is.
It's not necessarily a hard action. It's just them telling the market, trying to beef up confidence that way, isn't it?
Absolutely, exactly.
How much control do they actually have, though? Because the RBA can say that, but what if something external happen? Say in the state, I don't know what it might be, but can something happen where they are forced to raise rates?
Yeah, look, I think the biggest one is a genuine increase in inflation, quarter after quarter, month after month, and whether that means the currency absorbs the hit initially and you'll see a big fall in the currency because foreign capital decides to move out of Aussie economy because they see higher inflation, which will not be good for asset prices, those sorts of things. So to answer your question, yes, they can control it, but to a certain extent. And I think at the moment with huge amounts of debt, we're not really at threat of an inflation breakout, which the reason I think they're pretty safe to say that interest rates will stay low for years to come. And going back to this Life at Zero idea, that's the whole reason for it, because we are going to be in a low interest rate, constant stimulus environment for a number of years.
One more question on the bigger picture. So in 2008, when they really started stimulating the economy, you saw a huge effect. And I think from April 2009, that next 12-month period was a huge rebound. Then they brought in further measures, TARP, and QE2, QE3, but each time the effect was diminished. How crazy can they get this time?
What do? Very. I think we probably haven't seen all the different types of programs that they can potentially put together. I mean, we're now hearing about central bank digital currencies, and I think that gives central banks a lot more ability to direct where they want spending to go. So, I don't think we've seen anything yet. And I think the lesson from 2008, and I've talked about this in other sort of forums, is that's when the financial system, something happened there, something broke, and it never really recovered. And ever since then, the global economy has not been able to stand on its own 2 feet without some form of government or central bank stimulus. So, and that's one of the real lessons from post-2008 environment. Anytime you get central banks or governments trying to withdraw support for the economy, it rolls over, equity markets fall, and then it just brings them back into the game. And nothing has really changed from that story. And I think we're going to continue to hear it. And that's why bond yields are still really low. In the US, they're about 1.5%. So, that's telling you there's no sign of inflation out there longer term. And, there is a risk that bond yields will keep getting lower.
So let's turn to the investment strategy, Greg, because not only you highlighted this idea, you also had an investment plan to go with it. Do you want to give us an update on how that's going?
Yeah, I think, I mentioned, the structure of it a little bit earlier. Basically, the idea is to try to be in the market in as low a risk way as you can. And obviously, when you invest in stocks, there's always going to be risk. But we're trying to minimize those risks by focusing on larger stocks that are good value, out of favor, and might be at the start of uptrends, which suggests that you've got a little bit of momentum on your side. So, just for example, I've been putting quite a lot of energy stocks into the portfolio over the past 6 months, or really since the start of the year. They've done quite well. Just off the top of my head, we've got Whitehaven coal, which, coal was hated and terribly out of favor just a few months ago. And now we've seen coal prices rebound back to, multi-year highs. That stock's up nearly 30%. It's been volatile, but it's up nearly 30% from the initial recommendation. Recommended a couple of oil ETFs, and they're up 30%, 15%. Origin Energy is about even from where we recommended. It's still early days in that recommendation. And the only one that's really sort of gone the other way at the moment is Beach Energy, which had some issues at its Western Flank production, or oil reserves on the Western Flank, which is in the Cooper Basin. Had some issues there, had to announce a downgrade. But if you look at that stock on a 2 to 3 year time horizon, it's still incredibly cheap. So obviously keeping that in the portfolio. But then there's other things like a couple of months ago, I recommended a stock called I think it's Unibail Rod & Co, and it's a Dutch listed company, but it bought Westfield's mall assets, European and US mall assets a couple of years ago, which is why it's listed in Australia. That was trading at 30% of book value a couple of months ago, and that was based on the fact that Europe was in shutdown, and you could just tell that the market had dumped that stock and was concerned about the shutdowns. And I sort of took the view, well, okay, we're going to open up at some point. This is an incredibly cheap stock, and that's just starting to get re-rated now. It's up about 20% from where we recommended it. So there's been plenty of good opportunities. I think another one, we got into the banks when they were knocked down at the end of last year. And that was just based on, look, they're really cheap. The economy is obviously going to reopen, and they should do quite well. They've probably done better than what I thought. We just took some profits on some banks, took about a 50% profit on a few of the banks this week, just because I think a lot of the good news is priced in. It's probably worth taking some money off the table. But yeah, still seeing plenty of opportunities out there. I've just got an issue of the advisory out. Due out, well, you'll be listening to this on Friday. It was released on Thursday night. Got a couple of stock recommendations in there. I won't disclose the names, obviously, for the paying subscribers, but still seeing opportunities out there. But I do think it's also a time to probably take some money off the table where you've done quite well. And now looking at areas like gold miners. Gold miners have been knocked around quite heavily over the past 6 to 8 months, and I think in an environment where the market might sell off a bit, or there's just a bit more defensive aspect to the market, I think gold miners are good value around here. I'm recommending clients just beef up their cash allocations a little bit to take advantage of, if the market does sell off, have some cash to take advantage of that. And assets like the US dollar. I think if the global economy does slow down, the Aussie dollar always takes a hit, and the US dollar goes up. So that's another sort of defensive asset that you can look at. But the prime focus is looking for companies that are undervalued, and over a 2 to 3 year time horizon, you can look to make good double-digit returns from them.
Yeah, I was going to say for a long time it seemed like the value approach just wasn't right. It seems like it's the perfect time to be a value investor right now, doesn't it? Because like you say, you can't. The market environment is such that it's very risky, but it's what's going to happen if you stay in cash.
Yeah, absolutely. And you're right. The value style of investing hasn't really worked for a number of years, and that's purely just because of the run in tech and these massive big network effect companies like Google and Facebook and Apple and the FANGs and all that sort of stuff. I mean, that they have absorbed
the green stocks.
Yeah, exactly. Those as well. I mean, they've absorbed a huge amount of capital, but just recently, because I think the fact that they are priced, in some cases, I don't think the market is as overvalued as what a lot of people make out. When you've got bond yields, which is a proxy for a risk-free rate, when you've got bond yields at 1.5%, it can sustain pretty high asset prices and pretty high stock market values. So it's really about looking at these stocks individually and working out where the value is. And I think, just in some cases like energy at the start of this year and the end of last year, it was so out of favor because of this green revolution, and everyone thought the fossil fuels were going out of business, which is, crazy. It's going to take 10 to 20, 30 years for that to happen. And that just created a really good opportunity. And in the market, you're always going to find those opportunities. There will always be pockets that are out of favor. and that are worth looking at. It's just a matter of getting your timing reasonably right and making sure you do the numbers. I always like to look at stocks that have decent returns on equity because it suggests that they're highly profitable as well. So I'm not just buying value stocks or stocks that are cheap, because some stocks deserve to be cheap and they'll always remain so, and you'll never get a re-rating. So yeah, trying to look at these stocks that are momentarily marked down. They've got decent business models, and the good news is you can generally always find some of those out there.
So just to finish off, then, can I just ask you about Beach Energy? Because
Yep.
I know that this was you said in the last 20 minutes that long term it looks like a really good stock, but obviously it had some short term issues. Is that one of is that a potential company that readers can go away and do a bit of research on their own and judge whether there's good value there?
Yeah, absolutely. I mean, it's one of the I guess one of the prime value plays in the market, but at the moment, investors are a little bit concerned about the shorter term issues that it's had, and it's had to downgrade reserves at its Western Flank oil assets, but it does have a number of really interesting growth projects that are coming up. So it's investing huge amounts of capital in them. So that adds a bit of a risk, because if those projects don't unfold in the way that the market expects, then obviously, you've invested a lot of money and that you're not going to get the return on it. But just judging from the numbers that I'm looking at for the next couple of years, if the company does manage to execute and to deliver on those numbers, then yeah, at the moment the share price is very good value. But I think I don't want to say go off and buy it and put it in the bottom drawer. It's something that you do need to keep an eye on, because there are some shorter term issues around it. But this is the thing with being a value investor or trying to buy out of favor stocks. There's a reason why stocks are out of favor, and there's a reason why stocks are cheap. And you've got to, I guess, balance up the risk and reward of what you can make if you get it right versus what you lose if you get the call wrong. So what you want to try to do is put a floor in the price and say, look, I'm prepared to lose 40-50% on this to try and make 200%. And I think, if that's your equation, then that's fine, but you've got to be disciplined and say, well, I'm going to get out if it goes the other way, and then you just move on to your next thing. But certainly I think that is one worth putting on the watch list and keeping an eye on.
Cool. All right. Well, I think we can wrap it up there, Greg. It's been a good 20-minute conversation, and I believe we're going to be, over the next few weeks, we're going to look to be updating the Life at Zero thesis for what's happened in the market since we first launched it in February. So we'll look at that.
Yeah, definitely sounds good. And you're right. There has, the situation always changes, and there's always stuff going on. So be happy to do that update.
Cool. Thanks for your time, Greg. And I hope you enjoyed this episode of the Insider Conversations that we're doing. Cheers.
Thanks, guys.